They told you to load up on bonds as you get older. More conservative, less risk, play it safe. And if you're like most people staring at your portfolio right now, maybe you've already made that shift. 60% bonds, 40% stocks, because that's what the target date funds tell you to do. That's what every financial advisor says. Here's what nobody tells you. That conventional wisdom, the one that says dial down stocks and pile into bonds as you age, might actually be increasing your risk of running out of money. I'm Megan Ramshaw, CFP and lead advisor at MOKAN Wealth. Through working with pre-retirees and recent retirees, I've seen people follow the traditional playbook only to realize years later that their portfolios can't sustain the retirement they worked decades to build. That stops today. There's a strategy called a reverse equity glide path, also known as a rising equity glide path, which flips everything upside down. This isn't about chasing returns. It's about protecting the first 5 to 10 years of retirement when a bad market can permanently break your plan. Once you see how this works and why the research supports it, you'll start asking a very different question. Should I play it safe with bonds, but am I actually protecting myself against the risk that matters most? Let's start with what you've probably been told your entire investing life. As you get older, you should steadily reduce the risk in your portfolio. More bonds, fewer stocks, less volatility. This idea is so deeply ingrained that it just feels like common sense, right? If you've ever looked at a target date fund, you've seen this in action. Vanguard, Fidelity, every major provider has them. Here's how they work. When you're young, decades away from retirement, you're heavily weighted towards stocks, maybe 80%, 90%, even higher. The thinking is you can handle the swings because you've got time. Then as you approach retirement, your stock allocation steadily declines. The portfolio shifts more towards bonds, cash, and other stable stuff. By the time you hit your retirement date, you might be at 50% stocks, 50% bonds. And then after you retire, it keeps going down. The industry average shows portfolios at about 44% stocks at retirement, dropping to around 36% just 5 years later. Vanguard's 2020 fund, designed for people who've been retired for about 5 years, continues to decline toward 30% stocks within 7 years post-retirement. This is what everyone does. It's the default. And for many people, it works just fine. But here's the thing. It's not the only way. And for some retirees, especially those retiring early or facing 30, 40, or even 50 years of retirement, it might not even be the best way. So what's a rising equity glide path? And why is it also called a reverse equity glide path? Simple. You start retirement with a lower allocation to stocks, and then you gradually increase your stock exposure over time. It's reverse because you're doing the opposite of what traditional glide paths do. Instead of going from 80% stocks down to 40%, you might go from 30% stocks up to 70%. Instead of getting more conservative as you age, you actually get a bit more aggressive. But here's the critical part. This isn't about chasing higher returns. This is a risk management strategy, not a return-seeking one. The goal is singular. Protect your most dangerous years. Those early years of retirement when bad market returns don't just hurt, they can permanently derail everything you've worked for. We're talking about the first 5 to 10 years after you stop working. This is what researchers call the fragile zone. And if you've never heard of it, you need to understand it because it's one of the most powerful forces in retirement planning. Here's what makes those early years so dangerous. When you're working and contributing to your 401k, market crashes are actually kind of helpful. It sounds crazy, but it's true. When the market drops and you're still adding money every paycheck, you're buying shares on sale. That's dollar cost averaging. A bear market early in your career can set you up for massive gains later. But in retirement, everything flips. You're no longer contributing, you're withdrawing. And when you're pulling money out of a declining portfolio, you're selling shares at the worst possible time. You're locking in losses that can never be recovered. Even if the market bounces back later, and it usually does, the damage is already done. Your portfolio is smaller. You've got fewer shares working for you, and now you're asking what's left to carry you through potentially decades of retirement. This is called sequence of returns risk. Let me give you a real example of how brutal this can be. Morningstar analyzed 2 retirees, each starting with $1 million and taking $40,000 initially, adjusted 2% annually for inflation. Both portfolios achieved identical 5.89% annualized returns over 30 years. The difference is the order of returns. The retiree with strong early returns, 10 years at 12%, then moderate gains, then flat years, grew to $2.2 million by year 11. Their withdrawal rate was just 2.2% on that larger base. The retiree with the reverse sequence, flat returns first, then moderate, then strong, saw their portfolio shrink to $562,000 by year 11. Same average return, totally different outcomes. The second retiree's withdrawal rate spiked to 8.7%, and they were on track to run out of money. That's sequence risk, and it's the invisible force that can make or break a retirement. This is where the reverse equity glide path comes in. And I'm not just making this up or throwing out theories. The research behind this strategy comes from two of the most respected names in retirement planning, Wade Foe and Michael Kitces. Their 2013 paper, published in the Journal of Financial Planning, explored what an appropriate equity glide path should look like during retirement. These guys ran the numbers on decades of market data. Their conclusion, rising equity glide paths in retirement can reduce both the probability and magnitude of failure in client portfolios. Here's how it works. With a rising equity glide path, the retiree is less exposed to losses during the most vulnerable early retirement years. You're holding more cash and stable assets early on when a market crash could destroy you. You're reducing volatility right when it matters most. You're making your portfolio more resilient during that fragile zone. And then once you've survived those dangerous early years, once the risk of permanent damage drops, you shift back into stocks because now you need growth to sustain the next few decades. Their research found that portfolios starting at 20 to 40% equity and rising to 60 to 80% consistently outperformed traditional declining glide paths, with the 30% to 70% path showing optimal results. Let me show you what this actually looks like in practice. Let's imagine a hypothetical scenario where you retire with a $500,000 portfolio. With a reverse equity glide path, you might start at 30% stocks and 70% bonds. That means $150,000 in equities, $350,000 in more stable assets. Your goal at this stage isn't growth, it's stability. It's making sure that if the market tanks in year 1 or year 2, you're not selling stocks at a massive loss just to pay your bills. Now, instead of staying static, your equity allocation increases slowly and deliberately. This isn't market timing. You're not trying to predict where things are going. You're following a plan, a rules-based approach. You might increase your stock allocation by about 2 percentage points per year. So by year 5, you're at 40% stocks, 60% bonds. By year 10, you're at 50% stocks, 50% bonds. Eventually, maybe around year 15, you hit your long-term target. Let's say 70% stocks, 30% bonds. This is a hypothetical example for illustration purposes. In real life, assuming you're taking reasonable withdrawals and the market performs as it was historically, your portfolio will be much larger than $500,000 by year 10 or 15. The point is you're minimizing risk when your plan is most fragile and shifting towards growth when you can afford to be. Let's talk about what the average retiree is actually doing, because the contrast here is pretty stark. If you look at Vanguard's Target Retirement 2025 fund for people who are just about to retire, the portfolio is roughly 50.7% stocks and 48.6% bonds. Now look at their 2020 fund for people who've already been retired for about 5 years. The stock allocation continues declining toward 30% within 7 years post-retirement. Do you see what's happening? The default advice, the one that literally millions of people are following, is telling you to get more conservative as you move through retirement. But the research on reverse equity glide paths is saying the exact opposite. Start more conservative and then gradually become more aggressive. This flies in the face of conventional wisdom, and that's exactly why most people have never heard of it. Rising equity glide paths can be so effective that they may actually lead to lower average equity exposure throughout retirement while still delivering better outcomes. That's not a typo. Lower average exposure, better protection, superior results. Now, I need to be clear about something. This isn't for everyone. I've worked with plenty of retirees where the traditional approach makes perfect sense, but this strategy tends to work best for specific situations. If you're retiring early and have 30 or 40 years of retirement ahead, this could be a game changer. The longer your retirement, the more you need growth and the more you need to protect against that early fragile period. It also works well if you're heavily relying on withdrawals from your portfolio to support your lifestyle. If your portfolio is your primary income source, sequence risk is your biggest enemy. I've also seen this work really well for high net worth retirees who still worry about early market crashes. Just because you've got $3 million or $4 million doesn't mean you're immune to sequence risk. And it's a strong fit for people with a long life expectancy. If longevity runs in your family, if you're planning for 90 or beyond, you need your money to last and you need growth. On the other hand, the strategy is less useful if you've got a really short time horizon. If you're planning for 15 or 20 years, the traditional approach might be just fine. It's also less compelling if you've got significant pension or Social Security income covering most of your expenses. If much of your retirement income is already protected, sequence risk matters a lot less. And if you're an extremely conservative spender with a huge surplus relative to your needs, you might not need this level of protection. If you're headed into retirement and want to see your specific numbers or know exactly how a reverse equity glide path would work for your portfolio, your income sources, and your lifestyle, click the link in the description and see if we're fit to guide you to and through retirement. At MOKAN Wealth, we help self-made 401k and IRA millionaires keep more and pay less in taxes. We use our 5-seed system to address the 5 key areas of retirement planning: income, taxes, investments, healthcare, and legacy. You focus on living your best life. We handle the planning and investments. Get started now to see if we're fit. Thanks.